I'm Emily Shacklett, leader of executive services here at Fairport and Luma Wealth. We come to you today with video number 2 in our series, So You're Thinking About Retirement. In today's session, we're going to talk about what you should consider in those years post-retirement. So you've done everything you needed to do to make the best possible decisions to maximize your retirement. You've been out of the workforce now. What do you do next? So first, a simple one. Don't forget to keep funding your HSA, assuming you have an HSA eligible plan. Many people think, oh gosh, when I retire, I don't have income anymore. I can't fund my HSA anymore. And that's just not true. You can actually fund your HSA all the way up to age 65, regardless of whether you have any earned income. And that is a wonderful way not only to get a tax deduction, but also to save money tax-free and to accumulate this wonderful asset that you can utilize for long-term care type needs and medical needs when those costs ramp up later in life. Number 2, don't forget to manage your income tax brackets. Weirdly enough, the years immediately post-retirement can be wonderful income tax planning years. So many people these days, we're seeing a trend, are retiring much younger. They're retiring long before required minimum distributions kick in at age 72. And so there's these gap years between your high income earning years and your RMD years that tend to be in the lower tax brackets. Manage those tax brackets. Be cognizant of where you are and be thoughtful about things that you can be doing to maximize your decision making. Next one. This one sneaks up on people. Manage your Medicare IRMAA, IRMAA brackets. What is that, you ask? Well, once you go on Medicare at age 65, the cost is not the same for everybody. There is actually a list of brackets, depending on your income, that determines the cost of your Medicare. So a couple examples. If you are, as a joint filing couple, making $176,000 or less in taxable income, your Medicare cost is $148.50. Now understand that does change from year to year, but that's this year's cost. There's a whole slew of brackets that I'm not going to tell you all about, but you can look them up online. But what's interesting is if you look at the difference between that lowest Medicare bracket that I just talked about and the highest, so for earners at $750,000 or more, their costs go all the way up to $504.90 a month. Unbelievable, the increase in cost, and boy, can that hit you by surprise. So as you're looking at your tax projections and doing tax bracket management, be really thoughtful about IRMAA bracket management too. So now let's talk about fun stuff. What can you do to take advantage of being in a lower bracket between the time you retire and age 72 when your RMDs kick in? Roth conversions. This is a great way to balance out your assets. You may find that after all these years of working and your wonderful saving that you've done, you've really built up your retirement plan balances. So you have high IRA balances and high 401k balances. And that's great. That means that you saved tax deferred and built up those balances to help you in retirement. But the challenge is, if you're taking out distributions from those plans, you're now paying taxes on them, and that can put you in a much higher bracket. So in those years post early retirement, you have the opportunity to convert some of your traditional IRAs into Roth IRAs. And those Roth IRAs will be growing tax-free and distributed tax-free. So then you have this wonderful situation where you have choices. You have some Roth money that's tax-free. You have a taxable investment account that gets taxed generally at capital gains rates. And then you have your IRA balances, which would be taxed at ordinary income tax rates. And you can use those 3 buckets in a way that perfectly balances your tax situation in retirement. So be mindful and thoughtful about doing Roth conversions in those early retirement years. The last thing I want to mention is Encore career. Especially these days when people are retiring early, we see so many people embarking on an Encore career. And what does that mean? It generally means you get to do something you really love, and you do it for a lot less time than you did your previous job. You were probably working 40 plus hours a week, and now you can do something you really love, and you can do it 20 hours a week and spend time with your grandchildren. But in any case, things need to be considered when you embark on an Encore career. First of all, you should think about setting up an LLC, especially if there's any liability associated with what you're doing. That will help protect your other assets from any lawsuits that arise associated with this Encore career. Second of all, don't forget to review your non-compete. If you had non-compete provisions or non-solicit provisions in your previous job, just because you retired doesn't mean that those don't still apply. So make sure you understand what you are and aren't allowed to do as you embark on your Encore career. Next, fund a self-employed retirement plan. Yes, I know you're already retired. Yes, I know I just told you that you might even want to do Roth conversions. But the beauty is, if you're in an Encore career and you're still earning income, you can really mitigate your tax liability by saving into a self-employed plan, whether it be a SEP IRA or a solo 401k. The wonderful part of this is you are taking money out of your pocket and putting it into your wallet. You are setting aside money for yourself, but you're getting a tax deduction. So few things afford you that opportunity. But the HSAs we talked about, these retirement plans, those afford you that opportunity. And then last but not least, don't forget to consider your health insurance. Your self-employed health insurance is deductible against that Encore career income, as long as your Encore career income is self-employment income. And that is a great way to offset your income. So if you are in the first couple years post-retirement thinking about how to maximize and have any questions, please reach out to me or your Fairport and LUMA Wealth advisor, and we'd be happy to talk with you more about this. These are great years to maximize your future.